Hey, good morning once again, options traders. Well, a topic that really every trader should know is synthetic positions. You have to know your synthetic option positions. And a lot of times when traders are first starting out, they might be introduced to this or start dabbling in it and they say, what do you really need to know synthetics for? It's just a big waste of time. Well, it's probably one of the more important things that you can learn to be a good options trader. You need to understand what a synthetic equivalent is for a number of reasons. It might give you a cheaper way to construct a position. It will give you insights into various risks of a position. It'll help you to understand your hedges, rolls, and morphs by seeing what the synthetic equivalent is. So there's lots of reasons why you should understand synthetic positions. And for right now, though, what I want to do is to show you an easy way to figure out what a synthetic equivalent is just by looking at a risk graph or even maybe just figuring it out in your head, visualizing it. So let's go take a look at synthetic positions made easy. And before we do, as always, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So synthetic positions, what are they? Well, they're just very simply two different sets of positions or assets that produce the same risk graph. So the thing that I usually teach to show how really the mechanics of what makes a synthetic position is to understand that long stock plus a long put plus a short call equals a risk-free bond. Now, the shortened version is to say that the risk-free bond has no risk. So we can just shorten this to stock plus put minus call equals 0. And one thing you can do is to just isolate whatever it is you're trying to figure out. So if we want to figure out what a long call is, well, I've got a short call. I need to get that by itself. So one way is to just swing that over to this side. Right, from algebra, you would just add C to both sides. They'll cancel out over here. So you should be able to visualize that stock plus put equals a call. Or we could just say the call is a combination of stock plus put. So another thing to understand is that any one of these pieces, the stock, the put, or the call, can be made up by the remaining two. But more importantly, they will always have the same sign. So for example, if we have stock, call, and put, these are the three building blocks. If we're trying to figure out what a long call is, we know that part of the answer must be a put, but specifically a long put. So do you see that if we're trying to figure out a long call, we know that it's got to be a long something. They've got to have the same sign. But we can also not use the thing that we're trying to figure out as part of the answer. So if we're trying to figure out a long call, you know that a call cannot be part of the answer. That's why they're called synthetics. It's using other things. So if we're trying to figure out, let's say, a short call, you know that part of the answer must be a short put. Notice that they have, again, the same sign. That's going to be one of the little shortcuts that we're going to use. So how can we look at these and very quickly figure out what a synthetic equivalent is? Well, the first thing to realize is that your deltas always come from long shares of stock. So if you have long shares of stock, we have positive deltas, and you can visualize that to just see that this line kind of leans out this way to the right, or what we might call the northeast corner. It's leaning on this angle, and that will always come from long stock. So now let's try one. Let's look at a long call. We see our risk graph, or maybe just picture it in our head. Where is this coming from, this angled line? Well, I can tell that that's coming from long stock. The deltas are coming from long stock. Now, what else do we know? Well, we know that if it's a long call that we're trying to figure out, it has to be a long something else. The signs have to be the same, and it's just going to be the opposite. So the opposite of the call is the put, and there we go. We can tell that long stock plus a long put is a long call. So there you go. Your long call right there is a combination of the long stock, there's your deltas, plus a long put. Again, notice the connection that the sign of the thing that we're trying to figure out is positive or a long position, and therefore part of the synthetic is also going to be positive. So we would say that the combination of long stock plus a long put is synthetically the same thing as a long call. Or just saying long stock plus long put is a synthetic long call. So if we graph the long call, it looks like this little hockey stick. And if we were to graph the combination of long stock and long put, it would produce exactly the same graph. So that's how we know that those are synthetic equivalents. So it's really just that easy. Now, some of our risk graphs will have the angled part of the line, or the delta part, coming out this way to the left, or leaning to the northwest corner. And that's always going to come from a short stock position. So if you short shares of stock, this is your risk graph, just negative deltas all the way through, -1. So anytime you see that the angled part of a risk graph is leaning this way to the left, you know that part of the answer is short stock. That's the only way that you can get those negative deltas in there. So let's try one. Here's the risk graph for a long put, and so you want to figure out what the synthetic equivalent is. Well, what's the first thing that you know? The angled line right here is coming from short stock, so we know part of the answer is short stock, and then we just look to the long put to get the rest. We know that we're trying to figure out a long put, so part of the answer has to be a long something else. We know that something else is the opposite, so it's a long call. And there we go. We know that a long put is synthetically equal to short stock plus a long call. And if you, again, remember, the thing we're trying to figure out is long, and so part of the synthetic equivalent, the option, also must be long. But we just can't use put as part of the answer. It's got to be the opposite type of option. And I've said this many times before, calls are puts, puts are calls. And now you're seeing why. A long put is the same thing as a long call if we just delta hedge it with short stock. Okay, let's try another one. Short put. What does this look like? This is what we're looking at or visualizing in our head, and we're trying to figure out what the synthetic equivalent is. Well, we've got the angled part of the line is leaning out this way to the right. So we know that part of the answer must be long stock. What's the remaining part? Well, we're trying to figure out a short something, so we know the answer also has to be short. We can't use put as part of the answer, so we know it has to be a short call. So we see that long stock and a short call is synthetically equal to the short put. All right, so there we go. The short put, notice that it's short. We know that part of the answer must have a short call to it, and then we just figure out our deltas from the stock position. So if you were to short a put, this is the risk graph you would get, or if you were to buy shares of stock and short a call or sell a call, you would get exactly the same risk graph. Many of you recognize that as a covered call. So here's a real good use of synthetics. A lot of times people say that a covered call is a very conservative strategy. Most brokers allow the lowest level of options approval level to do a covered call, and yet synthetically it's exactly the same thing as a naked put, which requires the highest level of approval level. It's considered one of the riskiest types of options strategies, and yet they are absolutely identical, produce exactly the same risk graph. Okay, here's a last one for you to try. Short call. We're looking at this risk graph, or we're visualizing it in our head, and we're saying, what is the synthetic equivalent? Well, the first thing to notice is that we have our line, the angled part of the risk graph is leaning out here to the left. So we know that short stock is part of the answer. That's how we're getting these negative deltas in there. And what we're trying to figure out is a short call, so we know part of the answer also must be short something. And because we can't use the same type of option, it must be a short put. So it's the short put and the short stock that are giving us the short call. Again, notice that we have the thing that we're trying to figure out is short. So part of the answer must also be a short option. They carry the same sign, but we just can't use the same type of option. That's what we're trying to figure out. What is it synthetically equivalent to? So we know that a short call plus short stock equals a short put. And so again, notice that the thing that we're trying to figure out is short call. So it's a short position, and we know that the answer must therefore be a short option, but the opposite type. Trying to figure out a short call, we know that short put must be part of the answer, and then our deltas are coming from short stock position. So you could either short a call and you would get this risk graph, or you could short stock and short a put and get exactly the same risk graph. It's actually kind of the sister strategy of a covered call that's actually called a sell right. But I just thought that might help a lot of you to visualize your risk graphs, and it will at least give you some shortcuts to getting the right answer. It's still important to understand why these work. But for right now, or if you're just trying to come up with a quick solution to find a synthetic, hopefully that will give you a new tool to work with. But again, I can't emphasize enough how important it is to understand your synthetics. Because if you want to make good trading decisions, you have to understand all of the choices and all of the risks. And the best way to do that is to understand the synthetic combinations. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.